Bitcoin death cross, real danger, or bullish setup? Bitcoin recently rallied to a stunning $86,000. Yet, under the surface, a technical pattern has some traders on edge: the death cross. Traditionally seen as a bearish indicator, the death cross forms when the 50-day moving average dips below the 200-day moving average. But what does this really mean for Bitcoin right now? Should traders and hodlers be worried? Let's dig in. Disclaimer: this content is for informational purposes only and not financial advice. Please do your own research and speak to a financial advisor before investing. What is a death cross? A death cross is one of the most widely recognized bearish technical signals in trading. It happens when short-term momentum weakens and the 50-day moving average crosses below the longer-term 200-day moving average. In legacy markets, this signal often precedes downturns. In crypto, it's more complicated. A look back. Death crosses in Bitcoin history. Bitcoin has seen several death crosses over the past decade, and the outcomes have varied. March 2020. Bitcoin flashed a death cross during the pandemic crash, only to recover rapidly and start a historic bull run. June 2021. Another death cross occurred, but again, BTC found support and rallied later that year. January 2022. This time, the pattern aligned with a true bear market that lasted months. So the death cross is not a guaranteed crash trigger. It's more of a reflection of what has already happened. This time feels different. What makes this recent cross unique is the timing. It formed on April 6th, after BTC had already climbed back to 86K. That's not what we usually see with death crosses, which tend to form during a decline. This has led analysts to split into two camps. The bears argue the cross signals an incoming correction, especially if macro pressures resurface or ETFs stall out. The bulls believe this is a lagging indicator and not a threat, especially post-halving when supply squeezes typically follow. What to watch next? If you're a trader or long-term hodler, here are a few key things to keep your eyes on. RSI, Relative Strength Index. Are we entering overbought or oversold territory? On-chain data. Are whales moving BTC off exchanges? That's often a bullish sign. Volume trends. Are breakouts happening on high volume? Weak volume rallies tend to fade fast. Support levels, 80K and 72K, are critical. Holding those would signal strength. So, should you be worried? Short answer: stay alert, but don't panic. The death cross is a technical signal, not a prophecy. And in crypto, especially post-ETF approval and after another halving, it may simply reflect delayed market structure, not future doom. In fact, this could be a setup for a classic shakeout, the kind that flushes out weak hands before the next big move. Final thoughts. Bitcoin's volatility is nothing new. And while the death cross might look scary, it's context that really matters. With institutional adoption, stronger fundamentals, and the halving just behind us, Bitcoin may be setting the stage, not for collapse, but for another explosive chapter. So whether it's a warning or an opportunity, one thing is clear: stay informed, zoom out, and always HODL strong. Like what you're reading? Smash that like button, subscribe to our channel, and follow for more deep dives into Bitcoin, crypto trends, and market-moving insights. Let's navigate this cycle together.